Hello again, everyone, and welcome to today's webinar. I'm Nick Zulovich, part of the team at Cherokee Media Group and senior editor of AutoFin Journal and Subprime Auto Finance News. In today's webinar, Navigating Claims, Recovery in a Post-Pandemic World, we have a great session in store with Allied Solutions plus executives from IAA and DealerTrack. But before we get started, just a couple of quick housekeeping items for today's webinar. We are recording today's session and we'll make the recording available to you as soon as possible. Now to run down our panel of experts who are participating on today's session. Tab Edmondson is the president of DDI Technology and vice president of IAA Client Solutions. John Elias is Senior Director of Lender Sales at Cox Automotive and DealerTrack. Ann Holtzman is the Senior Vice President of Risk Management at Allied Solutions. And Peter Kroll is Vice President of National Markets at Allied Solutions. So that's enough, certainly more than enough for me. Show some manners here, and we'll begin ladies first. Ann Holtzman, the webinar is now yours.
Thank you, Nick, so much. And thank you to my fellow panelists and Peter Kroll, who's going to facilitate with us today. So happy to be with all of you. So a little about today's agenda. We already did the welcome and introductions, but thank you all for tuning in and listening to this webinar. We hope that you'll find it helpful as you begin to navigate our new market related to everything post-pandemic. We're going to go over a bit of a market overview, and that's critical to what we're doing today because it really feeds into some of the key takeaways and information we're going to provide to you in regard to what's going to happen in this post-pandemic world related to insurance providers and other service providers. So if we just simply look at some of the market observation and conditions, and most of this, as you all know, is something that is not going to be new for any of you. But as we look, we know that luckily on behalf of most Americans, the unemployment rate is continuing to drop and is improving by each month that goes by. I'll come back to that unemployment rate as something to watch out for as we enter into the end of 2021 and 2022, as it relates to insurance and service providers. As we all know, there's been a significant drop in the amount of new car sales in 2021, and a lot of that due to just very restricted supply and supply chain issues, especially the chip shortage. As we also know, because repossessions are approximately 50% of where they used to be, and are continuing now to uptick in some subprime segments, we're also seeing a lack of used cars in the market, which is increasing demand substantially and reducing the amount of supply that's available. That too, as we all know, is causing some very inflated used car prices, and we're going to talk a little bit about that effect on the industry as well. There's definitely, as we know, a lower new car inventory, almost 43% behind 2020 levels. Repossessions, again, we've discussed, have dropped to 1.3 million from an average of 1.8 in 2019, and actually an expected 2.1 million in 2021, which isn't coming to fruition. And finally, we're all dealing with significant increases in regulatory scrutiny, customer sensitivity, and how that's affecting things like collections, repossessions, insurance claims, and ancillary product refunds. So if we simply look at some of the market conditions, again, average vehicle price absolutely increasing, which means that loan balances are also increasing. The inventory is decreasing, so we have increased prices and then restricted demand, which again is forging prices upward and increasing insurance exposures for the voluntary insurance market. Also for supply unsold, limited now to 33 days, which is, as you can see, a significant drop, almost a 75% drop from what it looked like in 2019 and 2020. So contributing factors, of course, are the chip shortage, limited vehicle supply, and inflated values and vehicle prices. So as we look at that against what are the service providers focused on and what's affecting their world, it's a lot of additional state regulations. The fact that the car prices or the value of those cars have increased substantially for payouts from the voluntary insurance market. We're also seeing repossession and the lack of repossession inventory affecting the ability to get good prices and good parts on used vehicles, repair times, and the expense to put a consumer in a rental vehicle. All of those things are going to affect how service providers and insurance carriers are going to navigate this post-pandemic world. So as we look at certain market conditions and what you as lenders are probably experiencing out there, what you're going to see is a continued uptick in total loss units being declared as a part of the voluntary insurance market. So as we have people who are now returning to the roads, they're traveling at record pace, they're probably beginning now to commute to and from their office locations. We are seeing more vehicles than ever before being declared as total losses. You can simply look at 2019 compared to 2021 and the continued increase as a percentage of insurance carrier total payouts, the number of damage claims that are now declared total losses. The ACV settlement on these total losses is significantly higher than it was in 2019 and 2020, with an average increase in depreciated amount by almost $6,000 a vehicle. So the voluntary insurance industry is experiencing significant severity increases, even though they have been poised with reduced frequency of incidents and accidents. They're now increasing the amount of accidents and incidents that are occurring and the severity of those accidents and incidents, resulting in more total losses. As we look at our first poll question, we would ask you to respond. Are you experiencing an increase in total loss activity and claims within your institution in 2021? So as we can see in the results, there's been many of you, almost 50%, saying, yes, I've seen an increase in the amount of total loss claims that I'm dealing with inside my institution, compared to 24% that have not experienced that, and approximately 28% of you that it's still uncertain or the inability to track is difficult. Peter, I'll turn it over for you.
Yeah, thank
Start
you, Ann.
addressing questions to our panel. Thanks, Peter.
Absolutely. Yeah, appreciate the moderation. Great insights, Ann, on that overall intro. And as poll participants were starting to log in on an increase in total losses, just a quick aside. This couple of years ago, I took my car through a car wash, and one of the hoses broke off as the car was being washed. I didn't choose the total loss option, but the hose that hit the car, quarter panels, hood, roof, resulted in a settlement real quickly from the insurance company, the insurer of the car wash. and they deemed our used vehicle a total loss. It doesn't take much, to your point. But here's our first question for the panel, and thank you for being here today. Can you explain how the challenges from the past year and a half related to COVID-19 and certainly other factors have impacted collateral insurance coverage and services?
So Peter, if I could speak to that for a minute, IA has been in the service industry with insurance companies for many, many, many years. And what we've actually seen is the insurance companies had to navigate through this new world using different resources than ever before, and hit on so many of the exact targets that have affected them basically. But what they had to do was step back for a minute and say, okay, we are limited too with our availability, being able to drive around and being able to go to an office or even see our clientele, but they still needed to maintain that level of customer service that all of their clients were very used to. So as you started to see that, what they did is they had to turn to technology, and they went to partners that they trusted, and they said, hey, help us navigate through this. And I think this is one of the big things that really has led to their navigation through this really tough time for them. I know as IA, they came to us, and we came to other partners like DealerTrack and like Allied in order to help put those pieces together for them, because they wanted an end-to-end solution that could maintain their customer service, decrease the timeline to help make that happen, but still know that those partners were there to support them through this entire event.
Mm-hmm. So literally,
yeah,
sorry, I just to say COVID accelerated the technology there, Tab. That's a great point. And a good reference to you, Mr. John Elias. Please proceed.
No, I agree with Tab, right? I mean, the world was already, or this industry was already transforming pre-pandemic, but it wasn't transforming it as quickly as once the pandemic really started to kick in, and we started to see this acceleration to digital. And it was an acceleration across the entire transaction. And in effect, many of our customers had to pandemic proof themselves and pandemic proof this transaction. So you started to see more home deliveries, more dealerships digitally constructing contracts and signing contracts remotely, allowing customers to basically shop online, which had always been there, but it wasn't as popular. It wasn't really taking off as we thought it would initially. But the pandemic proved to be that catalyst that said, we need to move this transaction into the digital realm with confidence and securely, so that we can service customers, not only DealerTrack to our customers, but our customers to their customers, service them digitally. And you see that through the platforms that we offer and the technologies. You see that in the auctions and the auctions that we manage, and how we've we moved those to virtual, and ultimately how we've moved many of the other business outsource processes that we manage on behalf of our customers. We've been able to continuously staff and maintain through the pandemic as well. But the real emphasis has been on moving this through technology.
Yeah,
From pandemic to progress, right?
Yep.
Thanks, John. Yep. Ann?
And Peter, if I could add something, 32 years in the insurance industry, majority of that on the claims side of the business. When you kind of pull that curtain back and you look at how these insurance companies have to effectuate settlements, as a lender, the more you can use digital and electronic means to communicate with these carriers, the more effective and efficient you will be, and also the more likely you will be to optimize your recovery and get your funds faster and sooner in exchange for your titles, etc., working with these carriers. Because having been in that world for many, many years, what the pandemic did was force electronic and digitization that would have taken us 4 or 5 years inside insurance carriers. And so the more that you as a lender can take advantage of that when you're dealing with things that impact your business, the better off you will be, because they still, many of them do not have full return to the office plans, are going to try to find a way to support work from home, and honestly, less reliance on things such as email and telephone. So as we saw before, those increases in total loss numbers, those are going to plague the industry. A swing of 6 or 7% like that will impact the industry overall. So you as a lender optimizing electronic means to access communication with insurance carriers, I would have that as a key takeaway today, Peter.
Mhm. Great point, Ann. Pandemic to progress. Our
Yeah,
next
I
que-
think, Peter,
Oh, yeah. Go ahead,
just
John.
to Ann's
Yep.
point, right? When you start moving all this to technology and electronic transactions, you can gain data out of it, right?
Mhm.
And data helps you refine the process. It points you into the directions for efficiency. But more importantly, I think it also gives you the ability to forecast a little cleaner. And nowadays, that's obviously something that's a little bit tougher to do as we work our way through the economy and work our way through this pandemic.
You bet. Can't manage what you can't measure, right, John?
Right.
Wonderful. Yeah, our next question, we're going to come back to you, Tab. Have you noticed any changes in how insurance providers have shifted the way they approach business practices over the last 18 months?
Very much so, as a matter of fact. And it's interesting because what I think you're finding now is that all three of the panelists here, whether it's myself at IA or Ann with Allied or John with DealerTrack, is we're finding that really the way they're conducting business has changed dramatically. It's more of a virtual world, digitization, and everybody's concerned about timeline. You know, when IA first built IA loan payoff 2 years ago, we had no idea it was going to take off like it did in early 2020 as a result of the pandemic. We partnered with DealerTrack to build the solution that took the insurance carriers along with all of the lenders, and we've partnered with Allied as well too, as many of their lenders are now participating in order to make this a much more efficient process. Ann was right on the money. People are not going back to the office still. They need to be able to work wherever their office is. They can sit at home, they can use their computer, never pick up a telephone or fax something, but they can still settle that claim. They can actually say, okay, I want the title to be sent here. They never have to worry about a FedEx or something of that nature. And when you partner with great partners like, you know, whether it's DealerTrack or Allied or any of the others out there, it really is perfect, and it's a perfect scenario. And John's point's right on the money in the fact that as we've seen more and more transactions go through this platform, what it's done is it's given us that data analysis to know that those lenders and providers are saving upwards of 20 days in their timeline. Do you know what a day is worth to an insurance carrier? Because it's all about making it easier to settle with that owner as well too. Because that owner is now without their car. They've got to go out and buy another car, which means that lender is going to be involved. The lender wants to retain them and they want to come back. And now, once again, you've got all the same people participating that are just trying to make this a much smoother process.
Yeah, great point. Again, that progress through the pandemic. Ann or John, anything to add to what Tab said there?
Yeah, Peter, I guess the one thing I would add to that is, as I look at the industry overall, there's never been a time where there's been as much heightened consumer sensitivity as what we have today. So as these carriers have really gone through, and most of them, just for the audience's knowledge, are regulated state by state. It's not a national regulation for most voluntary insurance companies. It's state regulated and admitted. Each of them have to have different standards within different states to meet all the regulations. And I think the one thing that I saw the insurance industry do, which I give them huge kudos for during the pandemic, was make sure that people had their homes and vehicles insured, even if there was financial hardship. So that heightened consumer sensitivity will continue post-pandemic, mainly because the regulators and the states are going to be focused on it. So the more you as a lender help effectuate and move through processes that are sensitive to consumers, such as time, I think that you will find that is highly beneficial to your business as well.
Great point, Ann.
Mhm.
Yep. How about
Yeah.
you, John? Anything before our next poll?
No, well said, Ann. I think that you're dead on with saying that the regulation is going to continue. The regulation becomes tough to monitor because it's at a state level. And you know that there's always a consumer sensitivity in the regulation that's involved. So, having that ability to quickly service, more importantly, identify when there's a service that's inefficient or deficient and quickly addressing it. So great point.
And that leads perfectly to our next poll as the audience has been able to digest this. Please feel free to click and stick, as we'd like to say, in terms of being able to manage some of this, because I think the panelists have done a great job of describing how things have changed, how they've accelerated, and also how they've progressed. So we'll give everyone just a couple more seconds to fill out their poll and post the results. There we have it. Kind of almost a mixed response in terms of how difficult are you finding it to navigate recovery processes with service providers and insurance carriers. Not difficult, 16%. 32% had it rated as a 2 on a 5 scale. In the middle, 20%. And on the upper echelon, 24% were saying it was difficult, and 8% even very difficult. So almost a perfect bell curve, with a slight leaning toward not difficult, maybe with the technology accelerators we kind of talked about through the pandemic. So those are some great results. And Ann, we'd love your perspective on this, on what has that impact been on service processes and specifically with refund loss payments.
Yeah, Peter, so I kind of alluded to that whole consumer sensitivity. And if you look at any of the CFPB highlights, or you look at any of the blogs out there, the discussions with our new administration, as well as new leaders in each of the branches that regulate all the things that all of us do every day, that consumer getting every dollar that consumer is entitled to, related to a refund, a repossession, a lost payment, etc. That is by far in top focus for all the regulators, whether that's state or federal. That's out there, that consumers get every penny that they are entitled to without a long, drawn out, consternated process. Mm-hmm. Well, the one thing that this is doing is putting a lot of responsibility on service providers and insurance carriers to pay what they owe as quickly as they can pay it, as accurately as they can pay it, with full explanation. So you think about what that type of construct is on a provider that maybe was used to funneling through 40 to 60% less than what they are funneling through today. So just think about the cog in the wheel just in pure volume. And quite honestly, we have not seen the tipping point of this. Repossessions and total losses have not returned to pre-pandemic levels yet, but they're going to. And when they do, you're going to add to 40 to 60% workload. You're going to add volumes that are going to be post-pandemic, matching volumes from 2019 and before. And I think stressing those service providers in being able to provide what they need to do and what they need to be able to do based on the regulators that are going to be demanding that happen. And then consumers, on the other hand, speaking out through venues like class action lawsuits. And we're seeing that today, a focus on class action lawsuits related to ancillary product refunds. We're seeing that today. So I think, quite honestly, now is the time as a lender to get your tools and resources in place and a plan for 2022, because those volumes are going to return to those 2019 levels, and there's going to be increased demand for those service providers and insurance carriers to deliver to borrowers and consumers. John, I'll turn it over to you for anything you'd like to add.
No, I mean, and all the statistics are in, right? Delinquencies have been low. There's been a stay on repossessions. We know that there are issues when once those forbearances or those holds are lifted, you're going to see that volume spike up. If you read any class action suit that's currently out there, you'll see that they're clearly placing the onus for these refunds back onto the lenders and back onto the service providers. They're saying that it's not the consumer. The consumer has a right to a clean line of sight as to where's that refund at, how much is that refund, and when they can expect to get it. In the case of the repossessions, the banks are going to want to receive that as quickly as possible, because you have a possible deceleration, right? In the way the vehicles are just abnormally appreciating today. So you want to get those vehicles to auction as quickly as possible, get the top dollar out of them. So this system will want to work in a very timely and cost-effective manner once it really starts to kick in. So having everything prepared now and ready in anticipation of, we expect this to be an uptick in delinquencies, severe losses, and repossessions. So it's going to require us to either staff or move through technology to quickly address that.
You got it. Yeah, great points, Ann and John. In other words, sell more, but be prepared to refund more as we move to the next question too. Great insights. Really, what customer demands, we talked a little bit about this with the lender dealer, have become accelerated. What tools and technologies could lenders and dealers utilize to make that process more effective and more efficient, John?
Yeah, so it's points a little bit back into the direction of when we first started. And you've seen this movement of consumers wanting to shop from home, moving from the car lot to their driveway, right? Wanting to take deliveries, wanting to contract, wanting to remote. So we're seeing to remotely sign and execute documentation. So we've seen just a huge growth in this particular area, right? As dealerships and lenders are working together to embrace electronic documentation, service providers in the aftermarket to provide, menu systems and offerings, as well as the ability to execute those documents electronically as well. Those are the processes that we're seeing just kind of on the transaction side. If I step over to the servicing side of it, right, they're asking, the states are doing more ELT initiatives. So you're seeing more electronic liens. You are also seeing triggers being built into collateral management to identify aftermarket contracts to ensure that they're put into the queue for cancellation. And that cancellation could be for a number of reasons, right? It could be early payoff, it could be in the unfortunate circumstance of a total loss, it could be in a repossession. But on the front end, we've seen the digital, kind of the digital acceleration, as we spoke to earlier, and that really has to deal with the acquisition. And then on the back end, what we're seeing is trying to connect these disparate systems, right? You never thought of your collateral management system being connected to your aftermarket system, and you never thought of that being connected into your contracting system. Those are the integrations everyone's beginning to connect on the back end. To your point, how quickly, I want to as quickly as possible, identify an action that will lead into a reaction that I need to be prepared for and have my systems already set up for.
Tab, do you have anything to add to that? I think you said it well, John.
Yeah, no, I think John hit on a lot of excellent notes there. I think really, as we start to see the better communication between all of the lenders and the dealers and the carriers, as that starts to get better and more efficient, what they're looking for, though, is more and more data, right? So as they start to do this, they need to understand how to make better, more efficient decisions, because it's going to affect everybody's customer. So if you have one transaction, stop and think about the fact of everybody that's affected by the total loss on one car or the movement of one car. And so now everybody's trying to understand, how do I make this as less painful for anybody who's involved? Because if an insurance carrier is trying to deal with a lender, they've got the same customer. They want all this to go together very smoothly, very easily. And they're consuming the data like crazy. They are wanting to learn, how can I make this better? How can I make it easier? And how can I get on that same platform just to make it easier for everybody to deal with? And I truly think it's when we start to partner to make that available, that's when you start to see these types of things happen, because it's great, because now all of a sudden those customers see one universal place to go and consume it, right? So if we can offer that information to them and make their lives easier, subsequently those customers' lives easier, that's a win-win for everybody who's involved here, basically.
Mhm.
Yeah, I think one
Absolutely.
thing on that, Tab and Peter as well, is technology is a great leveling field, because customers of all sizes are being held to the same regulations. Maybe they don't all have the same capacity to build systems or staff to meet those. The technology helps them level it out so that they can all remain effective and efficient in regulation.
Mhm. I think that segues perfectly to our next question, John. And I loved when we were doing some prep for this, the way this is turned, right? What have been your best practices for adapting and adjusting, as a lot of folks like to say, a new normal, or as we came up with as we were going through some of these questions, the new, I wouldn't even call it new, the abnormal for auto collateral. And why don't we start with you on that one? I think Tab and John have said some great things that fall right into that wheelhouse.
Yeah, Peter. So I think as we think about what we call this abnormal, the abnormal of all this is that it's never going to go back to the way it was pre-pandemic. For service providers, for insurance carriers, and for those of us that support the services for lenders, it's never going to go back. So as everyone now has adjusted the playing field, we have to find ways on the back end servicing side to connect all of the dots for lenders who can make sure that they're doing that on behalf of their borrowers. And where we tend to focus attention as providers is up front, in that upfront lending space where things connect and you've got convergence of service providers, storage of data, et cetera. Now what's going to be mission critical is that we do it on the back end servicing side as well. And I think when we think about abnormal, I think about the fact that we're going to see stressors for insurance carriers and service providers that the pandemic has only increased, because what's demanded of them is going to increase post-pandemic, no question about it. So how do we tap one another with services and basically find a way to make them seamless and integrated? And I think that's how we're going to adjust for what we call this abnormal, which is being as thoughtful and providing outsourced services and systems that are integrated, that make it very easy for lenders to effectuate what they're going to be regulated to do, and service providers. And how we do that, to me, is going to be the key moving forward out of this pandemic.
Yeah, when you think about the new abnormal, we really touched on a lot of things, right? That new communication process, which, all of a sudden you start to get into potentials for fraud increases, supply limitations, inventory, high salvage values. And how is that excess inventory? What's that cliff going to look like, right? Tab, we'd like to kind of expand on that from your perspective too, as we're really centering in on things that are maybe never going to change again, in the sense of opportunities to do business in new ways.
Well, you're exactly right. And we've touched on this throughout. And really, we talked about availability of cars, right? So that availability of cars, both new and used, is having an effect on everybody, because you've got to go buy a car for a lender to finance it, right? So now all of a sudden that's limited. But if your car's total loss, okay, you still got to go find a car. So we start to look at these pieces of this puzzle and start to put it together. So this is now a new world that we are having to navigate through. And our partners, our insurance carriers and our lenders and that sort of thing, we need to be there to help them navigate through it. Because right now, and we talked about this early on too, and brought it up at the very beginning, the value of used cars is as a record high. We used to talk about depreciation. Today, it's appreciation. Did we ever think we'd be there? right? And you see car dealers all day long trying to buy cars on, don't buy a car, just sell us your car. They need cars for the market. So all of this and parts and availability to fix a total loss, all of these. And so as we continue to understand this new market that we're in, it's up to us as partners with all of our lenders and our carriers, our insurers and that sort of thing. How do we make it easy for them to do business? And I think as people, and we're talking today, we have a very common interest, which is customer retention, customer experience, and a shortened timeline for everybody involved. And it really is up to us to figure out how to give that to them sooner so that it's easy for them to do. And I think we all have the strength as integral companies to make that happen in a shared world.
Mm-hmm. That's a great point, Tab. I mean, we haven't even touched on things that are also consumer education, how quickly the world is changing around them, regardless of pandemic. EVs, hybrids, charging stations. John, anything to add to what Tab and Ann said there? Because it's rapidly changing where you have this excess inventory. You got new OEM, I'll call it goals for hybrid EVs coming out here on the horizon. Some of them are being accelerated. What would you say, John, in terms of how that really changes this whole new abnormal?
I think you have new expectations resulting in new requirements. The expectation now is I want to transact in a certain digital space that requires companies to build this out, to build that process out. I have an expectation that when I do transact, I'm doing it safely and securely and that my identification is not being jeopardized. It requires companies to build in safeguards within their digital platforms. I have an expectation that I will receive all of the money, or my payoff will be net, any financeable products that are reimbursable to me at the time I trade my vehicle in. This requires lenders to put processes in place to accommodate that and to also ensure that they have an auditable, trackable record, because we know that the expectation now is that this industry is speeding up and this technology is out there. It's going to become easier to regulate, and they're going to want to regulate more, right? Because the data reporting and what they'll be able to get from the systems is going to become more comprehensive as they seek to ensure that all the consumer privacies or consumer requirements are met. I think that macroeconomically speaking, right, we still have a few unknowns out there. We're not for sure ultimately where the administration will land on additional stimulus. We're unsure as to this EV cram down or this introduction of EV into the space and how that will impact. We know that these supplies, we still have a scarcity issue in vehicles, and that could last through the remainder of this year into the beginning of next year. We know that we have to be very cognizant. We see lenders right now, the expectation is to continue to offer aggressive rates, but how do you price into your rate a potential loss based upon a rapidly devaluating asset that at the current time of origination was hyper appreciating? So it just seems that there's a lot to take into consideration right now. There's a lot floating around the space. Taking your time and really devoting it to one of those is something you don't have a luxury on right now. You have to spread your time across all of these different moving parts and figure out, how do I best solve for these given the information I have today?
Yeah, forecasting, more data, more regulation. I think that segues perfectly to one of our last questions for this illustrious panel to address. It's hard to boil it down to one thing, I think, as evidenced by this great discussion here. But if you had to, what's the one thing you're expecting to impact the industry as we look ahead to 2022? And I'm looking your way for the one thing, as we like to refer to it.
I would say, Peter, I would go with increased expectations, increased regulations, and the ability to do things faster, better, and more accurately, always in the lens of compliance and the right thing to do for the consumer. I don't see that going away at all. As a matter of fact, I see that only heightened, and that's going to put added pressure on lenders, service providers, insurance carriers, any of us that touch this business. We have to be equipped to deliver that. And I think the other thing is specialization. Because of all of this, specialization is going to be required to get to optimization. And sometimes you can't be master of all. So you've got to look to your experts and your partners to say, I may need to outsource because I need specialization. And then I just need to be able to monitor and audit versus provide. And I think we're going to see more and more of that as we move forward.
Mhm. I like the word optimization, and in thinking about that, Tab, I'm looking your way, because if I had to boil down what we've been hearing here, that word seems to resonate a lot. Abnormal optimization. But Tab, what are your thoughts on that one thing?
Well, you pegged it exactly right. Nan did a great job to verbalize that. It really is about optimization. It's about we as individual companies to optimize ourselves to be good partners to our lenders, our carriers, and our service providers. But at the same time, we also have to make sure that we are listening to what they need. Regulation is part of it, but what is it that they need? How can we most efficiently provide it? And do we need to now partner with somebody else to give that? But really, it's about efficiencies for everybody, about decreasing the timeline to process any single transaction and making it right for that consumer, because that's really what it's all about. It's about settling the claim. It's about understanding what's involved there, but making it right for everybody who has now touched that claim. And I think really we're going to do that through technology. It's a virtual world today. And I think in the future, that virtual world's going to just grow more and more and more. We're not going to go back to 2019. It's just not going to happen. It's going to go to the future, and we need to be ahead of it so that we are now prepared for all of our partners that we do business with.
Mhm. Yeah, great point. Mr. Elias, dealer track perspective, what's the one thing to start really focusing on for 2022?
Take a little bit of a different direction and say it's going to be vehicle valuations. And I look at that for a number of reasons. I think that you potentially are looking at another negative equity situation, future negative equity situation. I think that you're looking at loss severity continuing to be very high. I think from a risk perspective, I think your loss severity on credit could be extremely high as we take these vehicles and they attempt to just to remarket them through auctions and find out that they're $10, $12, $15,000 less than what they even expected in their forecasting, which obviously is going to put pressure on the lending community. It'll put pressure on the consumers. I'm a little bit wary right now of what's going to happen with the valuations and the impact that it's going to have across all of these different sectors, the consumer sector, the lending sector, the insurance sector. And while we're doing our best to help educate and stay informed and use as much data as possible, this is an unprecedented time in what we're seeing with vehicles. So I would assume that aftermarket products are being sold at an extremely high rate, at a dealership. If I have limited inventory, I have to maximize my profitability across all of my different businesses, meaning my F&I shop has to sell as much aftermarket product as possible. Obviously, the car is going to be sold at retail plus. And if you want to get an idea out in the audience of what we're seeing today in the industry, go to any one of the websites that offer you an online quote for your vehicle. Plug in your details and see what they return to you. You may be a little shocked at the amount of money that they're willing to offer you right now to take your vehicle, and really look at the online retailers and go there and ask them about your vehicle valuation. They will literally drive out to your house the next day and cut you a check for the amount that they are quoting on that screen, and it will shock you.
Peter, I agree with what John said, and I think the issue is today, for probably a good 12 months, there's been some relief around deficiency balances and consumer deficiency balances when it comes to vehicles. That tide is not going to be a gradual turn. It's going to fall off a cliff as far as the values, and all of a sudden deficiency balance become front and center to how lenders are looked at and things are forecasted. And what I would say about that, it is in that area of deficiency balance, reducing it as much as possible, the consumer getting every benefit that that consumer can get as a part of those deficiency balances is where I think lenders have to have just a significant level of focus.
Mhm.
And if we think about it today, there is probably no better time for a dealer or financer to offer a gap product. Because when you look at what we expect used car values to do, that gap insurance or debt waiver is going to be critical to that consumer and that lender as these values continue to deteriorate.
Mhm.
So along with gap, though, if you go out there and just Google it, you're going to find a lot of regulations and a lot of focus regulatorily on that product, which means if the two areas you got to focus on inside your shop is those deficiency balances, and that can be for total loss or repossession, or a simple repairable claim that then isn't repaired because they can't afford the time at the shop, or there isn't enough shops to even do the repairs. And how can you reduce that deficiency balance and not try to collect dollars from a consumer when it should have been collected from an insurance policy or service provider? So I think those would be two areas that might be worth a lot of digging deep inside a lender's operations and making sure you've got all kinds of tools and resources to optimize those areas.
Mhm. Optimization and innovation, right? And like I think we even referenced a little bit earlier, great time to be selling and buying gap where we are with those current values or a depreciation protection. And again, to your point, Ann, making sure that we're actually able to track that refund where appropriate, and making those consumers aware every step of the way. Tab, any closing thoughts here as we look to kind of wrap up what the one thing is? I know we had a lot of great commentary there, and then we're going to get to some takeaways here.
No, I think really, I think great points have been made today. And I think what we have learned is the fact that we're all really looking to the future. We're understanding how to be the best partners that we can with all of our clients that are out there, basically. But the one thing that's really been consistent here is we always go right back to doing right by the consumer.
Mhm.
And you know what? That's what this is really all about. We've got lots of different elements out there, but I think if you always look at that to say, okay, what's right by these owners and these consumers, I think really you're never going to go down the wrong path.
Well said. Well said. I had to make a phone call to an airline this past weekend, and the hold time was 2 hours and 20 minutes. I think the consumer has a powerful voice right now. And thankfully I could opt to have them call me back, and we could, talk about how much the time value of money is. But great thoughts, Tab. And really, I hope for the entire audience, some of the key takeaways that we've boiled down here in a short but fast period of time here, is that the new normal is abnormal, right? We talked about optimization and innovation as kind of almost defining hallmarks of what that means in an abnormal world. This rapid change occurring throughout the industry, insurance claims, regulations, class action lawsuit, new administration. Regulators are looking into things that, quite frankly, we've never seen them look into before. Maybe that gets into more data, more regulation, who knows? But that data management and industry expertise and building optimized recovery life cycles will be critical looking forward and looking ahead to 2022. So we really feel it's important to stay engaged, stay educated. You got a great panel of folks here with a lot of industry expertise. We would encourage you for any questions you would have. Let this panel know. Let the great folks, Nick over at Cherokee Media know. We'll be happy to facilitate ongoing discussions around this. Nick, I want to thank you for being able to host us today. This was an honor and a privilege to be here with these great folks. And I'd like to turn it back over to you, Nick, for any next steps or follow-up Q&A.
Absolutely. Thank you to each of you for sharing such astute and valuable perspectives on the changing times that we are in. Again, there on the screen is the the contact information specifically for Ann Holtz, the Senior Vice President at Allied Solutions. So again, as Peter referenced, the key to all of this success is continuing the dialogue. So I think that sums it up quite well. Again, that's Peter Kroll and Ann Holtzman from Allied Solutions, John Elias from Cox Automotive and Dealer Track, and Tab Edmondson from IAA. Each of you, thank you so much for sharing the great perspectives, and definitely looking forward to when we can all get back together in the quote real world in person again, and not be limited to our digital pathways that we're utilizing here today. So thank you again to each of you.
Thank you, Nick.
Thank you, Nick. Stay well.
Thanks, Nick.
All right.
And thank you so much for joining us on behalf of Allied Solutions, Dealer Track, IAA, and all of us at Cherokee Media Group. We thank you so much for joining us, and we look forward to having you again next time.
Thank you.
Thank you.